Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to look at some of the big tech earnings that came out last week. I am a bit behind, but forgive me. Normally this channel has been doing a lot of SPAC content, but honestly SPACs are kind of dead right now. Nothing going on, not a lot of good mergers, de-SPACs falling, not a lot of value in SPACs at this point, so not a lot to talk about honestly. I think it's worthwhile looking at these big tech earnings because I think they show how powerful these behemoths actually are on how they're going to continue to be a big player in the S&P 500. Again, Amazon, Google, Microsoft, and Apple are probably four of my biggest holdings individually on an individual basis. I own these in my M1 Finance account. I own these in my individual account. And then I also have a bunch of index funds in my retirement account where these are probably the biggest holdings in those index funds as well because of how big they've become, and for good reason. A lot of people will say, hey, this is a $2.4 trillion company when it comes to Apple. How far can they go? And I feel like after this earnings, Apple is undervalued. And that's crazy to say when you talk about a $2.4 trillion company, but they are executing so well that it just blows my mind how well they're doing. And if you think about Apple as a company, I mean, look at services alone. In the 3 month period between March and June, these guys popped out 17.5 billion in services revenue alone, and that's a high margin business. This is more revenue than Adobe had in 2020, more revenue than Uber, Nvidia, AMD, all of these, Square, more revenue than all of these companies had in all of 2020, not just one quarter, is coming out through their services business. Similar thing on their product space. If you look at what's going on with iPhone, iMac, wearables, 29 billion in revenue for 9 months from wearables, home, and accessories. In 2020 alone, AirPods were like a $22 billion business. It's insane how good of a business this is, and it continues to be a good business. And I just wish I bought more of this company when it was trading at like a 10x PE, 10x over earnings a couple of years ago. I mean, if you look at Apple, even 3 or 4 years ago, you could have had this stock for like 20-30 bucks. It's ludicrous. And back then this was it's a one trick pony. They are really based on the cycle of the iPhone. If the iPhone ever fails, this company's going to go under. And the reality is the iPhone is never going to fail. It's so embedded in culture, it's so embedded in our lives that people who love the iPhone are going to keep getting new iPhones. And people say, oh, these earnings are because of the 5G cycle. And sure, that probably has part of it, but a lot of people probably don't even care about 5G. People just update their phones every 2 to 3 years. This is as good a business as there has ever been, and I don't think it's going anywhere. And I think right now, even at 2.4 billion, if you look at the 5 days since the earnings, they're down a little bit because they guided a bit negatively because of chip issues. But again, if Apple can't get chips, then nobody else can get chips. There's a huge issue across the board. I think the chip concerns are a bit overblown, especially when it comes to some of these large corporations such as Apple, because Apple is going to be able to get chips. They're just going to be able to get chips. They are the number one maker and user of chips, and they probably give the most margin to the manufacturers themselves that are going to supply Apple first of all over anybody else. So what are we looking at here? I mean, you could just look at the numbers. 81 divided by 59, 37% revenue growth. Absolutely ludicrous. The fact that this is a 43% gross margin business when it comes to hardware, when it comes to, more than half of their revenue being hardware, is absolutely ludicrous. The fact that they can sustain this for so many years is absolutely ludicrous. Over 9 months, these guys have grown at 35%. And again, this is not going to be a consistent 35% grower because there is a cycle to these phones. Sometimes there's new versions that are better than others, but they're still going to be able to generate free cash flow at a massive scale. And that's really what this story is about. This is a free cash flow play. And as these other parts of the business grow, it becomes less and less reliant on the iPhone. The Mac's growing, the iPad's growing, wearables, home accessories are growing, and then services is growing at a pretty massive clip. If you think about as a business, it's an S&P, it's like a top 25 business at this point, growing at 30% plus year over year. It's a 50 billion, it's like a 70 billion annual business at this point, given that this is 9 months. It's ludicrous given the amount of services that they have. And again, some of these numbers are a bit fluffy. There's that Google payment that they get like 9 billion for using Google as their default search engine. There's the App Store. There's Apple Care and services. Yeah, they're adding new stuff to it though. Apple TV Plus, I feel like, is the best. And again, this is going to sound crazy, but Ted Lasso is the best TV show on TV right now. That's it. The quality is very good on Apple TV Plus. The quantity sucks because you have like 8 TV shows to watch and they really need to make that better. But if they keep that quality up and the price point is there, I think the Apple TV service is going to be really good. With fitness being introduced, Apple One, all of that stuff, they're adding more and more people to subscription. My wife and I have an Apple Music subscription, for example. We both use iPhones. We are probably going to upgrade our iPhones in the next 6 months. The next iteration of the iPhone 13, I'm probably in. I mean, Tim Cook always says customers love the iPhone 12 on the investment calls, on the earnings calls rather, and I like it. I mean, again, people are Android, people are iPhone, but the people that love their iPhone just love their iPhone. People that love the Mac just love the Mac. The iPad, honestly, is probably, there aren't that many people making good tablets anymore. People have just kind of moved out of that space. It's like it's either cheap and mediocre or iPad, and you go one way or the other. And I think the iPad kind of made a resurgence. It was kind of on the downtrend, and it's back on the uptrend. And then the iPods, I mean, Jesus Christ, nobody expected that thing to be what it is. And people say, hey, Apple's not really delivering on the innovation anymore. But they've just added this $25 billion a year business in the last couple of years. And people are like, whatever. And again, certainly that's been reflected in the stock price going where it's been. But this is still at 25 forward earnings multiple, given that the stock market itself, what is the stock market? Market itself is at a 34, so forward earnings probably in the high 20s, given what the stock market's growing at. So you got this thing that's growing at 30%, that's producing a ludicrous amount of free cash flow, and then you got the stock market that's growing at like, maybe 8% if you're lucky. That's producing much less cash flow, and it's valued at a higher rate. I mean, what's the disconnect here? Why are people underestimating Apple? If you just look at their free cash flow, I mean, I'm going to look at free cash flow here. I have this little setup here. You've got 74.1 minus their expenses here of 7.8. Free cash flow for 9 months, guys. 9 months of $66 billion. So these guys produce $66 billion in free cash flow for 9 months. You can probably estimate around 13, 14 billion in the next quarter. So for a full 12-month basis against the 2410 market cap, you've got a free cash flow yield of 3.3% on this sucker. And then you look at the stock market sub 2%. What am I likely to buy? What is a better deal? I feel like the fact that Apple is underpriced versus the stock market is just an indication that people are undervaluing it. Because if you look at this thing and they say, well, it's already a 2.4 trillion market cap, how high can it go? Well, in line with the, if it's at like a 1.9, it should be a 4.2 billion market cap company. And that's not ludicrous in my mind. I feel like Apple is probably one of the safest bets out there. Apple and some of these other free cash flow generating businesses like Microsoft, like Google, like even Amazon, honestly, are probably some of the safest bets out there when it comes to the stock market in the next 5 to 10 years. And yeah, you can look at this stuff and say, well, they're already at 1.5 trillion, they're already at 2 trillion, they're already at 2.5 trillion. Can they really go higher? Why not? There's only, this was the same argument that was made when Apple was at 1 trillion and it was trading at a, 12, 13x PE or something like that. People were saying, well, how high can it go? Well, it's at 2.4 trillion right now. And you may say, well, can it really go to 4 trillion? I believe it could. And honestly, if Apple ever takes any significant dips because of the market, I'll buy more. But I already have a pretty significant position, so I'm pretty happy with where it's at now. I mean, my cost basis on this sucker was like $20. So again, that wasn't even so long ago. That was like 4 to 5 years ago. And I was just like, man, this thing looks like a really good deal back then. I should buy some. And this was before the split. So at that time, it was like 100 and whatever bucks when I was buying it. Maybe even $100 before the split or something like that. And I just should have bought more because it's an obvious deal. And I still think it's pretty much an obvious deal right now. You can't find anything better than a 26 PE ratio at this level of cash flow generation, at this level of um, growth, and this level of different categories, right? You've got multiple categories that are each growing in their own space. You've got each individual region growing. It's quite a business here. Really, the main risks are still probably China related. Are they ever going to do anything there? Obviously, some of the Chinese stocks are taking a beating right now. A lot of their business comes from China. If China ever does anything that says, hey, Apple, get the hell out of here, highly unlikely, but quite, not impossible given what China is apt to do. There may be some issues there. And if anything, the iPhone business in my mind is getting stronger and stronger as people begin to trust the security that comes with iPhone more, and the Mac business is getting stronger, the iPad business is getting stronger as competitors kind of wean out their wearables business, whether it's the iWatch, the iPods, whatever they may add in the future. Again, they don't have all successes. The HomePod wasn't all that amazing. The HomePod Mini, whatever. I think those are all fine products, but they're not really selling like hotcakes. But then you've got the services business that's really growing, that's going to continue to grow, that they're adding more things to. They're making this bundle more valuable. And I think this is still a business that's got a long runway ahead of it. And beyond that, this is a business that's got like, what, $200 billion in cash on their books, certainly some debt, pays a dividend, buys back a ton of stock every quarter. I mean, they bought what, 66 billion in the last 9 months. And they're going to continue doing that every year. I mean, are there better uses of their money? People might want a bigger dividend, but obviously this is more tax efficient in this manner. Should there be acquiring more companies? They're certainly plowing a lot of money into innovation as well, but they could be doing a lot more. I mean, not a ton of capex over here, but that's kind of the beauty of the business. You probably don't need a ton of capex. There's still R&D spend being done in there as well. I mean, you're talking about a business that puts $16 billion in R&D spend in the last 9 months. That's quite a lot. They've got a lot of stuff coming up, and not all of it has to be a success. In fact, the assumption here, at my mind, with where the market is priced in general, is that nothing will be a success going forward, right? This is priced below the market, and it's growing above the market. And I think even if it normalizes in a market range in the future, which it will, but I think this business can easily grow at 5 to 10%. But even if it grows at 0% for a year or two, even if the growth slows down or goes to negative because they had such a massive year this year, this is still going to be a business that's throwing out so much cash flow that it doesn't really matter. I mean, this is as safe as a bond right now. Unless something happens that absolutely destroys your business for whatever reason, this is safer than a bond. It's got a yield that is, pretty much where a bond is right now, which is nothing. And it's got growth potential ahead of you. So you've got, 3.3% free cash flow yield from a business that's going to continue doing that, better than the market, better growth than the market, better future prospects than the market in a lot of ways, in my opinion, with the R&D they have and the opportunity to acquire other companies they have. And I think this is just a buy for me right now. It's a buy always. Like, if you just want to buy Apple all the time, unless something changes in their business model, I think this is the safest bet in the stock market, and I absolutely love it. I would pick up more. I will pick up more if, I kind of wish that this little drop here was a bit bigger. I was a buyer a couple of months ago when it was in the 120s. And if it ever goes back into the 120s, I will be a buyer again. I mean, this is a stock that you've had a lot of buying opportunities as an investor. I mean, it's near all-time highs, and so is the market. If there's a market dip in the future, Apple will surely follow, but all that means is they'll buy more, right? That's going to be an opportunity for Apple because they're going to keep buying their own stock. They're going to keep throwing off cash flow like crazy, even if there is a recession. I mean, I don't think this is a business that's fully recession proof by any means, but I think this is a business with a cost structure that will allow them to make money even if their revenue falls due to a recession, right? They're going to have free cash flow during that time. They're going to be able to buy back stock. They're going to be able to borrow and buy back stock because their rate of borrowing is super low and their balance sheet is absolutely bulletproof. So Apple, awesome earnings. I think the reason it fell is because they basically said, hey, chip shorted in the future, our earnings in Q4 might be mediocre. They always say that. I don't really buy it. Again, 4.42 earnings per share, 438 diluted. So you're talking about 38, I think, projected The next quarter are 114, so you're talking about 552 earnings per share against a stock price of 145.86. So that's a PE, a forward PE of 26.4 against a market PE of 34, a forward PE in the 28 range. It's just ludicrous how unloved, and that's crazy to say for a $2.4 billion stock, but people hate on this company for a variety of reasons, and it's all silly Billy. And I mean, this thing was $70, $57 during the pandemic. It's tripled since then, doubled, tripled. Crazy how much value there was here, and I wish I had more money to buy more, but unfortunately I am poor. I am not super rich, so it be what it be. Then we can go to Amazon tanked a bit actually after earnings, which is a bit surprising. It's kind of twofold why they did. In the last 5 days they're down about 10%, but again, that's from all-time highs of 3,700. So first things first, earnings kind of missed the mark a little bit. People were expecting a bit higher growth. 113 divided by 88, only 28%. What a piece of crap. Am I right, guys? 28% growth. Who needs that? Still pretty solid growth. The other part of it is they essentially said, hey, our Q whatever, I don't know which the next quarter is, but it's only going to grow at 10 to 16%. And basically people are looking at that and saying, that's not what we really expect from a company that's priced pretty aggressively. You know, their free cash flow in the trailing 12 is only 12 billion compared to a 1.6.8 trillion market cap, so 1680. And then you've got 12 billion free cash flow, and I will caveat that, so less than 1% free cash flow yield. Again, year over year, if you look at, they spent a lot more money this year on capex. So really, historically, they've been in the 26 billion plus free cash flow range. I think if you normalize for the additional capex, it's in the 1.5% range, still below the market. But again, Amazon is very much in investment mode. You don't think about Amazon that way because it's been around for so long, but they are plowing a boatload of money into CapEx. So when you look at some of these free cash flow yields, when you look at some of these PEs in the 60 range, it used to be in the 100 range, it used to be in 200 range, and people are always saying, it's too high. The PE is too high. Who wants to pay 60 for a company that's now growing at, less than 30%, and in the future might grow at 16%? Who wants to pay more than the market? But that's a misleading statistic because they're spending so much more money in capex to grow out their high margin businesses, and that's what you want. You want AWS, which is growing at a massive clip, to grow even faster, and that's where they're putting their money. And this is really the key part of the equation for me. The online stores, yes, they're growing slower, 13%. After growing in the 40% range. And again, this growth was kind of pushed forward because of the pandemic, because more people staying at home and really spending more money online. Physical stores tanked then. Online growth grew, and physical stores are mainly Whole Foods here, so it's kind of surprising that they actually fell because, grocery stores actually did well during the pandemic, but this is mostly Whole Food stuff and maybe some other Amazon Go stores or whatever. But 13% growth, people look at that and say, oh, that sucks. 10% growth, people look at that and say, that sucks. But what's important here in my mind is that if you add this up, you've got about 57 billion maybe, right? But then you add all of these other services and you've got a $54 billion other business, that's third-party seller services, which is their marketplace space, more margin there. Subscription services, which is Prime, etc., more margin there. AWS, which is growing, which is actually accelerating growth, given that it's such a high business. It's very impressive. High revenue business is very impressive. And then you've got other, which is advertising, growing at 83%. So you've got accelerating growth in a business that's probably in the 10 to 30% margin range, depending on what you're talking about, and decelerating growth in a business that's maybe a couple percent margin business. That's good. That's good in my mind. You're improving the stuff that's a higher growth, that's a higher margin business, and you're kind of decelerating the stuff that's a lower margin business. In my mind, Amazon is not an online store play. It's certainly a good part of it, and it certainly is what got the business going. But what is valuable in the business now is all of this other stuff. It's AWS, it's subscription, it's advertising. I mean, their advertising business is becoming a huge deal, and that's a high margin business. 87% growth on a high margin business. Yes, please. AWS, 37% growth on a high margin business. Yes, please. 30% plus growth on other high margin businesses. Yes, please. The fact that probably next quarter or the quarter after that, maybe not during the Christmas season, but quarter in a couple of quarters, maybe even the next quarter, the other businesses are going to be more than 50% of the revenue versus the online stores and the physical stores. And that's really where this becomes a really interesting story for me. That's why I've been invested in it, because I thought this was going to be the truth in the future, and it's finally becoming the truth. And they're investing a lot of money to grow these other businesses, as they should, which is why their free cash flow is lower than it would be if they weren't doing that, which is why their EPS is lower than if they weren't doing that. And they're growing it at a pretty good clip, 30% plus on average, 80% plus on the ad side. And they're improving their margins as a result, right? So yes, they're throwing a lot of money in. And yes, maybe their growth will slow down because a lot of these parts will slow down. But I still think they're sandbagging on some of the 10 to 16% growth in quarter three. I think they're going to do better than that. And I think this is a stock that and again, this is another big position that I have, whether it's in M1 Finance, in my individual accounts, or in my index funds. If this stock gets back into the 3,000 range, which it really was just, a while ago, not that long ago, I'll pick up some more, because I think this is still one of the better plays in the market. I don't love it as much as I love Apple, because Apple is just like, wow, this is an obvious investment, and always has been and probably always will be, unless it starts soaring into the 50 PE range. Because really, going back to Apple, what's the fair value of that thing? The market values it at 26 PE, 3.3% free cash flow yield. And I think it should be closer to where the market is actually valued. It should be closer to at least a 34 PE. So if you think about that, you're talking about, another 30% growth runway ahead of it. If you're about, free cash flow yield wise, it's 75% higher. And that's certainly a valid argument, because Apple is a better margin business than most of the market. So Apple's really amazing, just going back to that. But then Amazon itself, what's the fair value here? I think it's probably a bit north of where it is now. I think there is certainly upside here, given where the growth patterns are trending. But I don't think this is an answer as Apple. I think this is easily a $2 trillion business, I think. So it might take a bit of time to get there. I think they're going to need some decent earnings in the next quarter or two, simply because people need to realize that this is no longer an Amazon.com business. It's the stuff you don't see that's driving the real potential of Amazon as a stock, right? It's AWS, it's ads, and sure, you see ads, but you don't really know that they're such a big part of their business anymore. It's third-party marketplace, which is still obviously out there, but they make more money on that. And maybe some of that is going to be diluted by other online players. But in general, AWS and ads and subscriptions are where this business is trending. And that's a good thing to see if you're an Amazon shareholder. So the fact that it's down because of forward guidance, sure, it's not amazing. But again, if this thing gets into the 3,000 range, I will certainly buy more. I think it's a spot right now where, the market is pricey everywhere. But it's gotten so pricey on everything else that these tech names are starting to make sense again. And that doesn't mean that it's a good investment in the short term, because if the market has a little bit of a hiccup and there's a little bit of a recession or something that we're certainly due for, Amazon, Apple, Microsoft, Google, all of these guys will certainly follow suit like they did during the pandemic, even if it's not really all that. Well, Amazon didn't really take that much of a dip during the pandemic. Well, yeah, they did. Even if it's not all that relevant to them, because I still think they're going to make money during difficult times. But those are going to be opportunities to buy. And for me, Amazon, for me, Apple, for me, Microsoft, for me, Google, these are companies that if I had to hold, if somebody said, hey, you can only buy 3 stocks, one of those stocks would be Apple, Another of those stocks would be Microsoft. And the third would be either probably Amazon or Google. Because with those three companies, and honestly, like with most of these companies alone, that's a tech ETF as a whole, right? These companies are going to be involved in everything and anything in the next 10 years. And I think there's more opportunities for valuation appreciation beyond the fact that they're already in the multi-trillion market cap, because that's just where the market's trending. These megalith companies are just going to keep doing better and better. They have so much money to pump into R&D. They have so much money to pump into CapEx. They have so much money to pump into stock buybacks, future dividends for all of these companies. Apple and Microsoft already pay one. Amazon's probably years away because they're still very much in growth mode. They're so huge. They have so much cash flow generation. Even Amazon, that's putting 50 billion in CapEx, is still generating cash flow, and then Apple's just throwing off so much money that Apple's free cash flow is higher than the revenue of the majority of the S&P 500. That's how crazy it is. So that's what we're looking at here. I think these are all solid earnings. I talk about Microsoft, but Microsoft, again, very solid company, solid earnings there too. Google's solid earnings there too. Own all four. Guys, let me know what you guys thought about these earnings. Let me know what you guys thought about this video. A bit different than what I normally do, but I like talking about standard stocks as well, and we'll do so more in the future. Please keep in mind, I am not a qualified financial advisor. Please do your own due diligence before making any financial investments and talk to a qualified financial advisor. I am long pretty much all of the stocks that I talked about today. I may be long other stocks as well that I mentioned today. Have a good rest of your day, guys, and hope you guys enjoyed the video. Let me know what you guys think about Apple, Amazon. Whether, as crazy as it sounds, are they underrated given where the market is priced today? There's a ton of these companies with, potential growth that are being valued in the 200, 300, 400 billion spots that have a revenue that's a fraction of the cash flow that Apple generates. So I think they're underpriced in a way. When I looked 10 years forward, is Apple going to be a good return at today's prices? Yes. Is Amazon going to be a good return at today's prices? Yes. Could it go lower in the short term? Sure. But would I buy if that happens? Of course, because I love both companies and I will be a holder for a long, long time. So thanks for watching. Have a good rest of your day.